Good afternoon, everyone, and thank you for joining our SRP education event, Roth 401k and 403b strategies. My name is Sarah Krapek, and I'm the Director of Participant Experience for SRP. And we appreciate you joining us in this third event in our 2022 education series. A few quick notes before we get started with our presentation content for today. All the lines are muted, but we do welcome your questions. We have a slightly different process for Q&A this time around. So what you'll notice at the bottom of the presentation slides is a QR code. We invite you to get out your phone, fire off on that QR code, and it'll take you to an online form where you can submit a question to us. I'll monitor those throughout the session today, and we'll get to just as many as we can during our time together. As well, this session is being recorded, and a link to the recording will be sent out to all those who registered later this week. With all that to say, I am pleased to introduce our presenter, my colleague today, Stacy League. Stacy is an SRP Managing Director out of our Austin, Texas office. She is a self-proclaimed economics lover and ERISA nerd. She's passionate about doing what is in the best interest of the amazing people who put their faith and trust in her as an advisor. Stacy, thank you so much for your leadership and your voice on this topic, and I invite you to take it away.
All right, thank you, Sarah. I appreciate that. That was a nice introduction. So I figured I would start today. And by the way, thank you everyone for joining us. I'm very excited and honored to do this topic. Very passionate about talking about Roth. So hopefully you enjoy the presentation today. But I figured I would start today by just sharing a little bit about myself. So like Sarah mentioned, I am in Austin, Texas, the office here in Austin, Texas. I have lived in Texas most of my life. I'm a little bit of a country girl, kind of have that Texas spirit, but I love horses, and my daughter and I do barrel racing. So I'm going to share a couple of pictures with you really quick here before we get started. So this is a picture of my daughter on her horse. Like I mentioned, we do barrel racing. For those of you who don't know what barrel racing is, it's basically getting on a horse, running as fast as you can around 3 barrels and trying very hard not to fall off. So I love it, but a lot of you are probably thinking, why is this lady sharing pictures of horses and barrel racing, and what does this have to do with Roth? Well, if you bear with me, I'm going to tie it together. But for me and my daughter, when we barrel race, if we want to have a successful run, you have to have the right tools and equipment, right? If you want to have a good run. So, for example, you probably want to have a good, strong, fast horse. That'd be a great piece of equipment to have. You probably want to have a really good saddle, right? So you don't fall off. Saddles are important. You might want to have some reins so you can steer the horse, tell it what direction to go to. So all of these things are tools and equipment that will hopefully result in having a successful run or a race. So very much like Roth strategies, Roth is a tool, right? It's a tool that you can have to hopefully get you to a successful retirement. And my job as an advisor is to hopefully educate participants and people on the best tools and equipment that's available to them so that they can have successful retirement outcomes. And so that's what I hope to share with you today. So with that being said, I'm going to jump into the presentation and get started. So like Sarah mentioned, we are here today to talk about Roth, and specifically Roth strategies that are available within your retirement plan, such as your 401k or your 403b. So many of you have probably heard about Roth IRAs or are familiar with Roth IRAs. We're going to focus today on Roth within your 401k, and that differs a little bit. Now, I will talk about Roth again a little bit later in the presentation and kind of tie the two together. But in the meantime, like I mentioned, we're going to talk about Roth strategies that are available within your employer-sponsored retirement plan. Now, I did want to mention up front that Roth within your retirement plan is not a standard option. Your employer does have to adopt it or elect it in order for it to be available to you as a participant. Now, for most of you on the meeting today, you probably have Roth within your 401k plan. The latest stats that I looked at show that about 86% of 401k plans now have Roth options available, and about 80% of 403b plans have the Roth option available. So there's a really good chance that the Roth is available within your retirement plan. But if you want to be sure, I would tell you to check with your HR or your benefits people within your company, and they can tell you for sure. So again, it's not a standard option, but most likely it's probably available for you. So what is a Roth? A Roth basically is a type of tax advantaged account that you can use to save for retirement. Plain and simple. It's just a type of account. Now, today we're going to talk about Roth, how it works, the benefits of using a Roth, and then things that you might want to consider in determining if it's the best option for you. Okay, so those are all things that I want to cover with you guys today. Okay, so Roth contributions. Here's the basics of how they work. So remember, we're talking about Roth within your retirement plan, like your 401k or your 403b. So Roth is an after-tax contribution. What that means is when you get your paycheck, you figure out how much are you going to contribute into your retirement plan. Then what happens, you get your check, you pay taxes on the full amount of your paycheck, and then your money, your deferral, your contribution comes out of your paycheck after tax. Okay, so it is an after-tax contribution. That money then will go into your account that's set up within your retirement plan for you, and it gets invested according to your investment preferences. Okay, so you make investment elections, and that money gets invested within your retirement plan. Now, during your working career, that money grows and compounds, right? And that growth is tax-free while you're working during your career. And then once you reach retirement age, the withdrawals, when you're ready to start taking that money out, those withdrawals are tax-free to you. And that's the huge benefit of Roth, right? Is that you get to take advantage of potentially 10, 20, 30, 40 years of investment growth and investment compounding. And as long as you are at least 59 and a half when you retire, 59 and a half is what the IRS considers retirement age. And as long as you've had your first contribution has aged at least 5 years, then all of your withdrawals are tax-free to you. So all of that investment growth is tax-free to you during retirement. All right, so most of us are very familiar with the traditional way of saving in our retirement plan. So the traditional way is pre-tax. So I want to just do a quick comparison between pre-tax contributions and compare it again to Roth and how Roth works. Now with pre-tax contribution is just that, exactly that. It comes out of your paycheck before taxes, pre-tax. So in that same example that I just used, if you get your paycheck, you get to take your contribution out first. So whatever amount you've decided you're going to take out of your paycheck and put into your retirement plan, that gets to come out of your paycheck before you ever pay taxes on it. Okay, so it is a pre-tax contribution. Then that money will go into your account that's set up in your retirement plan, and it gets invested according to your investment preferences. And then it will grow and compound tax deferred, right? So you're not paying taxes as you go along on it. Then when you reach retirement age and you get ready to use that money and take distributions during retirement, that's when you pay taxes, right? You pay taxes after the investment growth. So just to reiterate, pre-tax, you don't pay taxes up front. You're choosing to defer everything. And then when you reach retirement, that's when you pay taxes on the withdrawals, on everything, income tax. Okay, so when we compare that to Roth, remember, with Roth, we're going to choose to pay our taxes up front. So we're going to pay taxes before the investment growth. Then the money goes in our account, grows and compounds. And again, when we retire and get ready to take those distributions and withdrawals to live off of, that money is now tax-free to us because we've already paid our taxes up front. Okay, so that's the difference between the traditional pre-tax and then the Roth after tax. So what's right for you, right? What's the best option for you? I often tell people to ask themselves this question, would you rather pay taxes on the seed or the harvest? Okay, so with a Roth, a Roth represents the seed because you're paying taxes today on the smaller amount, on the seed that you're going to put into your account. And that seed will hopefully grow into a harvest, right? So with Roth, you're paying taxes upfront on the seed. With traditional pre-tax, you're choosing to pay your taxes on the harvest. You'd rather get your tax break today, not pay taxes today, defer everything until you reach the harvest, until that money has grown, and then you're going to pay taxes on the harvest. So do you pay taxes on the seed or the harvest? And some things to consider in determining which one you want to do, there's just some general rules of thumb we have. The general rule of thumb is that the younger you are, the longer your time horizon until you reach retirement, the more beneficial Roth is for you. And the reason for that is because you have more time for your investments to grow and compound and really take advantage of that tax-free investment growth. Okay. Also, if you're younger, typically when you're younger, you're just entering the workforce. Maybe you're just starting your career and you tend to make less money, right? Once you start your career, you make less money, so you're in a lower tax bracket. If you're in a lower tax bracket, you might as well just go ahead and pay your taxes today while you're in a relatively low tax bracket. And that would be Roth, right? Because you're paying your taxes today. And then as you go through your career and you advance, you probably get salary increases, you make more money, you move into higher tax brackets. So you may not always want to pay your taxes today, right? Later on in your career, as you make more and more money, maybe later on in your career, it makes more sense to do pre-tax so you can get a tax break. Okay, so that's why we have that general rule of thumb. The younger you are, Roth tends to make more sense. Now, again, everybody's situation is different, and there's a lot of advantages to Roth and getting tax-free growth and having tax-free distributions. So age isn't the only consideration, but it certainly is a big one. Okay. All right. So we have talked a lot about the basics of Roth and how it works and talked about this concept of investment growth. But I thought it might be helpful to look at some numerical examples so we can look at and kind of quantify what does it mean? How does Roth really impact me? So let's first look at how does Roth affect your paycheck? Okay, Roth is an after-tax contribution. Okay, so we're going to look at this example of Lisa. Now, Lisa makes $40,000 a year, and she has decided that she wants to contribute 6% of her paycheck. Now, if Lisa does this 6% as a Roth contribution, that 6% is equivalent to $200 per month. So Lisa is going to pay her taxes on her paycheck. Her $200 a month, or her 6%, is going to come out of her paycheck, and then it's going to go into her retirement account. So her take-home pay is reduced by $200, right? The amount of her contribution. That's what she actually feels on her paycheck, is a $200 reduction because of that 6% contribution. Now, if Lisa had decided to do a pre-tax contribution of 6%, it would feel a little bit different to her. Now, remember, with pre-tax, her 6% contribution, or her $200, gets to come out of her paycheck before she pays taxes. So Lisa in this situation is actually getting to save some money on her tax bill, right? So her reduction or her paycheck, it feels like less. So even though she's putting the same $200 into her 401k or her 403b, it feels like less money on her paycheck. It's actually equivalent to $156 reduction on her paycheck. And that's because she saved real tax dollars today. Okay, so pre-tax can have a little bit less of an effect on your take-home paycheck. So a lot of you are thinking, well, why would I do Roth then? I mean, if it feels like less and the same amount of money is going into my account, why would I do Roth? Well, remember, the real benefit of Roth is the savings that we get down the road, right? So if we look at the effect that Roth has on your nest egg, this is kind of what ties it all together. So we're looking at the same example of Lisa. She's 35 years old. She's going to retire when she's 65. So she has 30 years of savings, right? So she puts her $200 in every month. She does that for 30 years. She gets an average rate of return on her investments of 7%. And so over the course of that 30 years with investment growth and investment compounding, her account balance will grow to $226,705.89. Okay. Now, if she had done that pre-tax savings, she still owes the IRS money, right? When she retires at the end of the day, she still has to pay her tax bill, her IRS tax bill. And so she doesn't really own that full $226,000 that's in her account. She has to pay the IRS their share. So what she gets to keep after her tax bill is about $176,830. Now, that's if she had done it pre-tax. Roth, if she had done Roth, she already paid her taxes up front, remember? So now the full $226,705 is her money. That belongs to her, right? She doesn't owe the IRS any of that. So she got to take advantage of that investment growth and not have to pay any taxes on that investment growth over the course of that 30 years. And so that's the benefit of Roth. So even though the effect on her take-home pay was a little bit different, right? She had a little bit less on her take-home pay because she paid taxes up front. She gets the benefit of not having to pay taxes when she retires. Now, remember, I keep telling you and I keep repeating the fact that the longer you have, the longer your time horizon, the more beneficial Roth is, because of the power of investment compounding and investment growth. So I want to look at one more example with Lisa, but we're just going to extend her retirement a little bit. So in this next example, we're going to look at Lisa's going to retire when she's 70, right? We're going to give her an extra 5 years. So if we just tack on 5 years to her retirement time horizon, she's now going to save for 35 years, the same $200 per month, get the same average rate of return of about annual rate of return of 7%, but she's saving it now for 35 years. Look at the difference in her account balance when she retires. So it's over $100,000 more, right? Just by saving that additional 5 years. So now she will have an account balance of $331,768. And if it's Roth, remember, if she had done Roth, that whole $331,000 belongs to her. She's not going to pay the IRS anything. But if she had done it pre-tax and she still has to pay her tax bill, she's going to lose, right? She's going to lose a little chunk of money. The IRS is going to get a nice chunk of her money. And she only owns $258,779. So you can see, again, just the benefit of Roth and not having to pay taxes on that money during retirement. So when you look at your retirement account balance, think about how much of that account balance actually belongs to me. How much of that account balance do I get to use during retirement? Do I own all of it? Or does the IRS still own a little piece of it? Okay, and so that might help you make the decision on, do I do Roth? Do I do pre-tax? So just some things to consider. All right, so these are some kind of pretty common questions I get quite a bit about Roth. Probably the biggest one is, do I make too much money to contribute to the Roth 401k or 403b? And the reason I get this question is this is where people start getting a little bit confused about Roth IRAs and then Roth within your retirement plan, and they're a little bit different. So we're going to talk about Roth IRAs on the next slide, but I will just tell you, with a Roth IRA, there are income limits. So if you make too much money, you cannot contribute to a Roth IRA. But if you're doing Roth within your retirement plan, your 401k or your 403b, there are no income limits. It doesn't matter how much you make. You can make $1,000 a year, you can make $1 million a year. If you want to contribute to Roth, you absolutely can. So you do not have to worry about income limits. Is it too late for me to start saving in the Roth? Answer to that, it's never too late. It really isn't. Now, we've talked a lot about how it's more beneficial to have Roth when you're younger, but you can start Roth at any age. You know, there are always benefits to Roth. Okay. So if you're 55 and you want to start saving for Roth, great. The only thing I will tell you here to think about is your Roth contribution has to age 5 years. Now it's 5 years from the date the first contribution goes in. So as long as you've contributed to Roth at least 5 years in your account, then it's a tax-free withdrawal at retirement. Okay, so just consider that. If you're 61, when you start making your first Roth contribution into your retirement plan, just know, even if you can retire at 65, you probably don't want to take it out until you're 66, right? Because you have to be 66 that 5 years in order for it to be a tax-free distribution. So that's the only thing I would tell you to keep in consideration there. Can I save pre-tax and Roth after tax? Absolutely. I work with a lot of participants who choose to split their contributions. You don't have to do all one or the other. It can definitely be a combination of both. So let's say you want to contribute 10% of your paycheck. You can do 5% pre-tax and 5% Roth. You can do 3 and 7. You can do whatever combination you want, but you absolutely can still do both. Some people like being able to save a little bit in tax dollars today, but they really want to grow their tax-free bucket of money for retirement as well. So there are advantages to both, and you can do both. And then, will my employer match my Roth contributions? Now, if you have a match in your plan, your employer is contributing matching dollars, most likely, whether you're doing pre-tax or Roth contributions, you are going to get the match. Okay, so you will get the match regardless of pre-tax or Roth. You'll still get the match. Now, it is important to know if you're doing Roth and your employer is contributing matching dollars, those matching dollars are not going to be tax-free distribution to you. Okay, they're going to be tax deferred, and you will have to pay taxes on the matched dollars when you retire. But the Roth contributions that you put in, of course, will always be tax-free to you. All right, so I promised you we talk a little bit about Roth IRAs. And I wanted just to touch base on the differences between Roth IRA and then Roth within your retirement plan, whether it's a 401k or a 403b. So let's focus on Roth IRA first. With a Roth IRA, there are contribution limits. You can only contribute up to a certain dollar amount each year. And these limits change. The IRS updates and releases the limits each year. But for this year, it's $6,000 that you can contribute to a Roth IRA. If you are over the age of 50, you can contribute another $1,000. That's your catch-up contribution. Okay. Now, I told you, if you make too much money, you can't contribute to a Roth IRA. And so there is an income phase-out limit in that income level. If you are single and you're filing as a single taxpayer, that income limit starts at $129,000. So at $129,000, you're not able to contribute the full amount to a Roth anymore, and then it phases out completely until you hit $144,000. And then once you hit 144,000, you can no longer contribute to a Roth IRA at all. Okay. Now, if you're married and you file a joint tax return, you get a little bit extra money. You can earn a little bit more. So the income limit for married filers is a phase out between 204,000 and 214,000. Once you hit 214,000, you're no longer able to contribute to a Roth IRA. So that's why we often get that question about, do I make too much money to contribute to Roth in my retirement plan? So with the retirement plan, remember I mentioned just on the previous slide, doesn't matter how much you make, you can still contribute. Even if you make $1 million a year, and I know we all want to make $1 million a year, I do, but if you do, you can still contribute to Roth within your 401k or your 403b if you want. There's no income limit. And then the contribution limits, how much you can put into the plan, are much higher in your retirement plan. So if you look on the slide here, you can contribute up to $20,500 this year, 2022. And then if you're over the age of 50, you get an additional $6,500 catch-up contribution. So for those of us that are lucky and over the age of 50, we can put $27,000 into our retirement plan each year. And we can do the full amount as Roth if we want to. Okay, so the Roth option within your retirement plan is just a more flexible. You don't have to worry about income. You can contribute much higher limits into the Roth within your retirement plan. Okay. All right. So I'm big on examples. I think numbers really drive the point home. So I just wanted to show you one more example here, a numerical example of the potential benefit of Roth and how powerful it can be. So in this example, we're going to look at Melissa. She starts saving at the age of 35, and she saves $10,000 a year, every year, until she hits age 65. So she saves for 30 years. Now, at age 65, Melissa's account balance grows to $945,000. That's beautiful, right? A lot of that account balance is going to be due to investment growth. And if she had done this as Roth, the full $945,000 belongs to Melissa. That's her money, right? She doesn't have to pay any of those dollars to the IRS in a tax bill if she had done it as Roth. Okay. So let's look at the breakdown. Okay. She saved $10,000 a year for 30 years. So she put in $300,000 and she paid taxes on $300,000 because she did it as Roth, right? Now it grew to $945,000 by the time she retired. So she had $645,000 in investment growth alone, okay? And because she did this as Roth, she does not have to pay taxes on that $645,000. That's all tax-free investment growth. I mean, that's a gift, right? Like, where else can we make money and not have to pay taxes on it? So Roth can be super powerful in taking advantage of those higher limits and being able to contribute in your retirement plan, no matter how much you make, can be a powerful thing, right? Not to have to pay taxes on those dollars during retirement just means you get to keep all of that money. You own more of that money during retirement. It can spread out longer during your retirement years because you don't have to pay a chunk of it to the IRS. So Roth can be a huge tool in your tool belt, right, to have a successful retirement. Now, one other thing I just wanted to touch briefly on about Roth, because it's a little bit different, that is also an advantage, are the RMD rules. So you're probably thinking, what is an RMD? An RMD stands for Required Minimum Distribution. Now, typically, when you save on a pre-tax basis or you save in a traditional IRA, at a certain point, the IRS is going to make you take distributions from your account. They're called required minimum distributions. They start at the age of 72 right now. So 72 is RMD age. That's the year the IRS says, hey, you need to take money, whether you need it or not, right? And they make you take out a certain amount because they want you to deplete your account over the course of your retirement years. Those are required minimum distributions. If you have your money in a Roth IRA, you are not required to take distributions. There are no RMDs if it is a Roth IRA. So this is nice, and a lot of people will use this as kind of an estate planning tool because they might want to pass on money to their heirs, and they might want that money to be tax-free to their heirs. So if you don't need the money during retirement years, just leave it in your Roth IRA. You're not forced to take RMDs, and then you can leave it invested for your heirs if you want. Okay. Now, it is important to know I'm talking about Roth IRAs. If you have Roth within your retirement plan, so within your 401k or 403b, it is still going to be subject to RMD rules unless you're still working. Okay. If you're still working, you don't have to take RMDs. If you're retired and you just leave the money in your 401k or your 403b, you're going to be subject to RMD rules if it's within your retirement plan. So my advice would be, if you have Roth money in your retirement plan, roll that money out of your plan into a Roth IRA once you reach retirement. And then, as long as that money is in your Roth IRA, it's protected. You don't have to take RMDs. And if you don't need it, you can just let it grow, continue to grow tax-free and pass it along to your heirs. So it's just kind of a nice little estate planning strategy that you can put in your tool belt as well. All right, so just some general considerations to think about with Roth in trying to figure out, is it the right option or is it the best option for me? So remember, time horizon is important, right? The longer you have, the more it makes sense to do Roth because you have longer for that money to grow, compound, stay invested, and take advantage of that tax-free investment growth, right? So time horizon is important. It's not the only thing to consider though, right? Think about your tax bracket. What tax bracket are you in today? What tax bracket do you think you're going to be in down the road when you retire? What do you think is going to happen to tax rates? Do you think we have lower tax rates in general right now? Do you think maybe the government's going to raise tax rates over time and maybe they're going to be higher during retirement? So if that's a worry for you, just pay your tax bill today. If you're not sure what's going to happen, or if you're really worried that tax rates are going up, just pay your taxes today. That way you don't have to worry about it down the road, right? So think about current and predicted tax brackets. If you think you're going to be in a higher tax bracket 30 years from now, because you've made a lot more money closer to retirement, then, maybe it makes sense to pay your taxes today and to do Roth. So just another thing to consider. Are you eligible to contribute to a Roth IRA? If you make too much money and you cannot contribute to a Roth IRA, then maybe it makes sense to contribute to Roth within your retirement plan, especially if you want to have a tax-free bucket of money to draw from during retirement. Okay. And for those of you who don't know this, or you may not know this, you can actually contribute to a Roth IRA and your Roth within the retirement plan as well, whether it's 401k or 403b. You can do both. If you're under the income limit and you want to max out both options, you can do that if you want. And then think about how your other accounts are being taxed. If you have other investment accounts, let's say your whole life you've contributed pre-tax to your retirement plan, or you had a traditional IRA that's pre-tax, and you're going to have to pay taxes on that money during retirement, and you're going to have to take RMDs on that money during retirement, then maybe it makes sense to do more Roth, right? Have different buckets of money to draw from during retirement. Roth can be a really great tax planning strategy during your retirement years. If you're able to draw some money, taxable income from pre-tax accounts, and then balance that out with tax-free income from your Roth, you're able to potentially keep yourself in lower tax brackets during retirement years, right? Because you can use that tax-free distribution to supplement your income without pushing you into higher income tax brackets during retirement. So it can be a nice tax planning strategy as well. And then another thing just to consider, since we're kind of talking about tax planning strategies, Medicare. Once you're eligible for Medicare at age 65, your Medicare Part B premiums are the amount of your premium is based on your income, right? So if all of your retirement income is taxable to you, meaning it's pre-tax money, and you're pushing yourself into higher tax brackets, you might be paying higher Medicare premiums because it looks like you make more money, right? So again, having some Roth money to keep yourself in lower tax brackets might also help you keep your Medicare premiums a little bit lower as well. So there's a lot of advantages and things to think about and consider when it comes to Roth. I highly encourage you to always talk to your advisor. We have a lot of great SRP advisors out there. Talk to your advisor if you have questions and you're not really sure if it's right for you. And then one final thing that I just want to mention that it's important to consider with Roth is if you live in a state that has state income tax, it is important to consider state income tax rules as well. Now, there are some states out there that offer tax breaks on retirement income, meaning they will not tax you on income that comes out of pension plans, retirement plans, such as 401ks and 403bs. So if your state is already giving you a tax break or a tax-free distribution, and they're not going to charge you state income tax, you definitely want to think about that and consider that in determining whether you want to do pre-tax or Roth, right? Because in that situation, maybe pre-tax still makes sense if you're getting the tax deduction and you're already getting a tax-free distribution. So just think about more than just the federal income tax if you live in a state that has state income tax. Again, if you have questions, I highly encourage you to talk to your advisor about that and see if you're in one of those states, or at least consider it when it comes to Roth. Okay, so I've thrown a lot at you today about Roth, but that's pretty much all I have as far as prepared materials. If you liked the information, if you would like to have access to additional information, we do have some resources available on our website, srpretire.com. You can scan this QR code and it will take you directly to the website. And there are some supporting materials about Roth. A lot of the things that we talked about today during this Roth presentation will be out there. There's some flyers that you can print off or save to your computer or look at on your phone, however you want to access that. So again, if you like the information, you want to have a little bit more information, go to our website, pull the supporting materials, documents off the website. They're there and they're available as a resource for you for sure. And with that, I'm actually going to turn it back over to Sarah to see if we've had any questions. Sarah, before I turn it back over, I wanted to mention one last thing. I'm sorry.
Sure.
For those of you that don't have Roth option available in your retirement plan. So you remember way at the beginning, I did talk about the fact that you might not have Roth available in your plan. If that's you, but you still want to be able to save in a Roth IRA, we can definitely still help you with that. We have a wealth division here at SRP that can help you with IRAs. And if you look at the bottom of this page, you're going to see an email address. It's plantoday@srpretire.com. If you are interested in a Roth IRA, have questions, just need some advice on it, feel free to send an email to that email address. One of the members of the wealth team will definitely respond to you and can help you with any kind of Roth IRA related questions. So just know there are still options available for you if it's not available in your 401k or your 403b plan. Okay, I promise, Sarah, that's all I have. So I'll turn it back to you for questions.
Yeah, no, it's all valuable information and you did a great job, Stacy. There is a lot of meat on that bone to speak. So To that end, we did get a number of questions throughout the presentation, so I am going to fire off maybe the shortest question that has ever been submitted during a webinar. It was 2 words, and it was define younger, right? So we talk about if you're younger, it might be a good option for you. Can we really put an age on that, or how would you frame up what younger is defined as?
Yeah, that's a great question. That's one I've never had before. So, and a very fair question. So, younger is all relative, right? And so, when I say younger in general, I mean the longer you have for that money to grow and work for you and compound, the more beneficial it's going to be. There's no set age, right? You can be 50 and it's still beneficial to do Roth. You can be 20. Obviously, if you're 20, it's super beneficial, right? Because if you're 20, you have 45 years for that money to grow and compound. So, very fair question. No specific rule to that. Just know that the longer you have, the more beneficial it is. I will also tell you there are calculators available everywhere where you can actually key in like your age and how much you're contributing, and it will give you a break even on what makes more sense for you given what your time horizon is. Like, is there a certain point in time where it doesn't make sense to do Roth? And those are Roth calculators. So most of our retirement plan providers, whoever handles your retirement plan, those calculators are available on their websites. And there's a lot of places you can go and just search for those calculators too.
Yeah, Stacy, that was actually another question that came in, a recommended calculator. So I was going to mention that in addition to the record keepers like Principal, Fidelity, John Hancock, whomever your plan is with, I also find the AARP website to be useful. They have a nice calculator at aarp.org. So I would point participants in that direction as well. So question about withdrawals in retirement. A participant in today's session asked, for 401k withdrawals, do you have to pay taxes on the whole account or just the amount you're withdrawing? So for example, if you take out $30,000, but your balance is a $300,000 balance, what exactly are you being taxed on when you take out that money?
Yeah, that's a great question. You're only being taxed on what you withdraw in any specific year. Okay, so if your account balance is 300, but you're only taking out 30,000 this tax year, you're only going to be taxed on the amount that's actually coming out. Okay, so that's why we tell you when you get to retirement, don't take everything out at one time, right? If you took the whole 300,000 out, you'd have to pay taxes on the whole 300,000, and you probably just pushed yourself into the highest tax bracket, right? So you're only taxed on what actually comes out each year.
So another question is, and I think it's important to reiterate, Stacy, you mentioned that it doesn't have to be all or nothing, that you can do a little bit of both. Someone said, so would I want to go 100% Roth, or is it better to go 50-50 Roth and pre-tax? So can you just reiterate some commentary on that?
Yeah, absolutely. And that really, really depends on your situation, right? So if you are just paying, you owe money in taxes at the end of the year, you hate how much you're paying in taxes, you're just trying to find ways to reduce your taxable income today, absolutely, it can make sense to do some money in pre-tax. And there's no set or perfect amount to do, like 50% pre-tax or 50% Roth. It really just kind of depends on your situation. And if you're hurting and you just hate paying taxes and you'd rather just, lower your tax bill, you might want to skew more towards pre-tax, right? But if that's not you and you don't really care and you usually get a tax refund anyway at the end of the year, maybe you want to skew a little bit more towards Roth. So there's no right or wrong answer. It really depends on you as an individual, where you're at and where you're like feeling the hurt, so to speak. If you'd rather get the tax break or the tax-free growth.
Sure. So we have someone who said that they make too much money to contribute to a Roth IRA. Would there be a penalty to roll Roth 401k dollars into a Roth IRA? Can you do that during your working years?
Okay, good question. So with most retirement plans like 401ks and 403bs, while you are still working, if you're actively working at the company that you have those Roth dollars saved, you cannot roll out of the plan while you're actively working. Okay. But let's say you have an old 401k or an old 403b, you're no longer with that company, but you had $50,000 of Roth money in that retirement plan. You can absolutely roll that into a Roth IRA. Once you are no longer actively working with an employer, if you had a Roth balance, you can roll it to a Roth IRA, no penalties. If you've reached retirement age, 59 and a half, most plans, even if you're still working, will allow you to roll money out of the plan into an IRA. So if you have Roth dollars, you can roll it to a Roth IRA. If you had pre-tax dollars, you can roll it to a traditional IRA. So it kind of depends on how your plan's set up. So again, I would ask your advisor for sure on the specifics, but there's no penalty to roll Roth dollars into a Roth IRA.
So here's someone who wants to grow their money as fast as possible. It says, will focusing on one or the other, Roth versus traditional 401k, help grow your investment any faster?
Okay, another great question. One versus the other is not going to help your money grow any faster. Okay, so whether you do pre-tax or Roth, it's all getting invested the same way. And the same dollar value is going into the account, whether you're doing pre-tax or Roth. Okay. Now, that brings up a great point. And one thing I did not touch on, if you are contributing a percentage of your paycheck, let's say you're doing 10% of your paycheck, 10%, whether you do pre-tax or Roth, is going to be the same amount. A lot of people think that 10% is going to be a little bit less if you're doing Roth because you're paying taxes first. That is not the case. Your contribution, your percentage contribution is always based off of your gross paycheck amount. Okay. So it doesn't matter whether you're doing Roth or pre-tax, the same dollar value goes into your account. It gets invested the same way and it grows at the same rate of return. So that doesn't impact it. What is impactful is at the end of the day, how much of that money do you own? Is all of it yours? If you did Roth, all of it's yours. If you did pre-tax, remember the IRS gets their piece too. So it grows at the same rate of return. It's just what do you own when you get to retirement?
So, Stacy, I think that pretty much takes us toward the end of our questions. You ended up addressing some questions within some other answers. So I think we did a great job of covering those. And I just wanted to, first of all, thank you so much for sharing your knowledge and spending this time with us today. I want to reiterate to everyone who joined us today that a recording of this call will be made available and emailed out to everyone who registered. So perhaps you'd like to share this information with someone at home or a coworker, or a small study group within your organization. It will be readily available for you, as well as those Roth resources. Oftentimes we know that you may not be making financial decisions all on your own. Maybe you have a planning partner or someone that you want to educate on this topic. So those takeaways could be a really great starting point for our conversation about Roth versus traditional and saving for retirement in general. So again, that takes us to the end of our time together today. Thank you again, Stacy. We encourage everyone to stay tuned for our fourth and final event, which will be in November. So invitations to come later this year in October, and we look forward to seeing you all again next time. Have a great afternoon.
Thank you, everyone.